The 2008 financial crisis. The 2008 crisis began with the safest thing an American can buy: a house. For years, banks handed out mortgages to almost anyone, including people who could never repay them. Then they did something clever. They bundled thousands of these risky mortgages together, sliced them into financial products, had them rated as safe, and sold them around the world. The biggest banks were borrowing roughly $30 for every dollar they actually held. The whole system was a tower built on one assumption, that American house prices could only go up. In 2007, house prices went down. On September 15, 2008, Lehman Brothers, a Wall Street firm that had survived the Civil War, 2 world wars, and the Great Depression, filed the largest bankruptcy in American history. The Dow lost more than half its value. Unemployment hit 10%. The government spent $700 billion to stop the bleeding. A 158-year-old firm died in a single weekend, and it almost took the world economy with it. The Great Depression. In October 1929, the most respected economist in America announced that stock prices had reached a permanently high plateau. Weeks later, the market began the worst collapse in its history. The 1920s had roared. Ordinary people poured their savings into stocks, most of it borrowed. You could buy on margin, putting down as little as 10% and borrowing the rest. As long as prices rose, everyone was a genius. When prices started to fall, the loans were called in all at once and everyone had to sell at the same time. On Black Tuesday, October 29, 1929, the market fell apart. But that was just the beginning. The Dow would keep falling for 3 more years until it had lost 89% of its value. It did not return to its 1929 peak until 1954. A quarter of the country was out of work. You've heard the stories of ruined bankers leaping from Wall Street windows. Almost none of it is true. The suicide rate that autumn was actually one of the lowest of the year. The panic was real. The legend was invented. The COVID crash, the fastest market crash in history, wasn't caused by greed or fraud or a bank. It was caused by a virus. In February 2020, the stock market was at an all-time high, riding the longest bull market ever recorded. Then the world shut down. There was no bubble to explain here, no financial mechanism to untangle, just a planet of investors realizing all at once that nobody knew what was coming. They sold everything. The S&P 500 fell 34% in 33 days, the fastest crash from a record high in history. The circuit breakers that halt all trading were triggered 4 separate times in a single month, and then something happened that would have been unthinkable in 1929. The government moved fast. The Federal Reserve cut interest rates to 0 and printed money without limit. Congress passed a $2.2 trillion rescue. The market fully recovered in under 5 months. In 1929, no one came to save the market. In 2020, that lesson had finally been learned. The dot-com bubble. For a few years, the easiest way to become a billionaire was to build a company that lost money, as long as its name ended in .com. The internet arrived, and Wall Street lost its mind. Investors stopped asking whether a company made a profit and started asking whether it had a website. Startups with no earnings and no plan to make any were valued in the billions. A company called Pets.com raised $82 million, ran a Super Bowl ad with a sock puppet, and went bankrupt 9 months later. The tech-heavy NASDAQ index peaked in March 2000, then fell 78% over the next 2.5 years. Around $5 trillion in market value evaporated. The companies were worth billions because everyone believed they would matter someday. Then the market remembered that businesses are supposed to make money. The panic of 1907. In 1907, there was no Federal Reserve. When the American banking system began to collapse, there was only one man powerful enough to stop it. It started with a failed scheme to corner the stock of a copper company. The failure triggered runs on the banks connected to it, and then on the Knickerbocker Trust, the 3rd largest trust in New York. Fear spread from bank to bank. People lined up to pull out their money, and the more they pulled, the faster the system died. There was no central bank to step in. There was only J.P. Morgan. The 70-year-old banker turned his private library into a war room, summoned the heads of New York's banks, and, according to legend, locked them inside until they agreed to pool their money and save the system. It worked. The panic stopped. The market had fallen nearly 50%. One man personally halted a national collapse. The country decided it never wanted to depend on one man again, and 6 years later, it created the Federal Reserve. Black Monday. On October 19, 1987, the stock market suffered the worst single day in its history. There was no war, no failed bank, no reason a human being could see. By the 1980s, large investors had handed their decisions to computers running a strategy called portfolio insurance. The idea was simple. If the market starts falling, sell automatically to limit your losses. The problem was that everyone's computers were programmed to do the same thing at the same time. When prices dipped that Monday, the machines began to sell. The selling pushed prices lower, which told the machines to sell more. In one day, the Dow fell 22.6%, still the largest single-day percentage drop ever recorded. Around $500 billion vanished, and yet there was no recession. The market recovered within 2 years. The worst day in market history had no villain and no cause. The computers had simply taught each other to sell. The flash crash. On May 6, 2010, the market lost nearly $1 trillion in minutes and got most of it back before the afternoon was over. The machines that crashed the market in 1987 had only gotten faster. By 2010, much of the market was run by high-frequency trading algorithms, buying and selling thousands of times per second. That afternoon, a single large sell order hit a market with almost no buyers. The algorithms passed contracts back and forth like a hot potato, then withdrew entirely. For a few minutes, some of the largest stocks in America traded for a penny. Others spiked toward $100,000 a share. The whole thing reversed within the same hour. Years later, regulators traced a key role to a trader named Navinder Sarao, who, according to the U.S. Department of Justice, made at least $12.8 million manipulating the market from his parents' house outside London. The newest kind of crash didn't need a panic or a bubble. It needed a few minutes and a man in his bedroom. The South Sea Bubble. Long before any of this, before computers, before the Federal Reserve, before the United States existed, the world had already invented the stock market bubble. And the smartest man who ever lived fell for it. In 1720, a British company called the South Sea Company offered to take on the government's national debt in exchange for shares. There was almost no real business behind it, just the promise of riches from trade with South America and a great deal of bribery of politicians. It didn't matter. The public went mad for it. Shares rose from around £128 to over 1,000 in a single year, then collapsed back to where they started, ruining thousands. Among them was Isaac Newton, who lost a fortune. Legend says he sighed that he could calculate the motion of the stars, but not the madness of men. He almost certainly never said it. The quote was invented decades after his death, and even the South Sea Bubble wasn't the first. Nearly a century earlier in Holland, people had traded a single tulip bulb for the price of a house in a frenzy we still call tulip mania. Though, fittingly, even that story turned out to be mostly exaggerated. For 400 years, the madness has worn different clothes: a flower, a trading company, a mortgage, an algorithm. But it has never once gone away. The market always recovers. Some companies never do.